Hey everyone, me Kevin here. I went through the entire 1-hour presentation, or well, podcast discussion that Jerome Powell had this morning, and I cut this down to the most salient and most important pieces. What I'm going to do is I'm going to play those pieces, and I'm going to pause to add commentary as necessary. And folks, there's a lot of juicy stuff in this about the future of the market. Inflation, is the course we're on sustainable in the United States? What the heck is happening with stable coins? And does that mean anything for cryptocurrencies? Folks, buckle up. Let's listen to J-Pow, the man with the money printer, who, by the way, also probably would recommend that you get your free $51 by depositing $100 with Webull and $100 with M1 Finance. You get $30 with M1 Finance and 4 free stocks with Webull worth at least $21 and up to $1,600. Okay, folks, those links are below. Let's go listen to Jerome.
We're no longer going to raise interest rates just because, for example, if unemployment were to be well below our current estimates of the natural rate of unemployment, that wouldn't be a reason to raise interest rates unless we see troubling inflation or other imbalances that could threaten achievement of our mandate. And that's a significant change. If you read the transcripts that were released of 2015, there was a lot of discussion of the issue around, could we let unemployment go below the natural rate? We saw what happened. I mean, we were the first group on the committee to see a sustained period of very low unemployment in many years, and we saw that it didn't produce troubling inflation, and we very much took that on board.
In other words, this becomes really important here because there's an old train of thought, old school thinking, and this used to be true, that the lower unemployment goes, the faster inflation will go up. The reason is if the unemployment rate goes down under, let's say, 3%, well, what happens? Unemployment rate goes below 3%. Now, all of a sudden, it's companies have to be more competitive to get people employed because there are so few employees available. And so they offer those employees more money. Those employees have more money. They get to go spend more money. And boom, you get more demand for products and services, which increases the prices of those products and services, which creates inflation. And so there's this historic sort of belief related. It's called the Phillips curve, by the way. We'll hear about that in a moment. But there's this belief that the lower unemployment goes, the higher inflation will run, and that is sort of a natural expectation. Jerome Powell here said, no, we're not going to raise rates anymore just because inflation is going down, or because unemployment is going down, rather. So if you're worried that, hey, well, what if unemployment goes back to like 3%? What if we recover really well in 2021 here? Are we going to get rates that automatically get pushed up because of that? And Jerome's saying no, that interest rates are going to be totally disconnected from what unemployment does. Now, yes, one of the goals of the Fed is to maintain maximum employment, but that does not mean once that goal is achieved that interest rates will go up. And that the other mandate, the price stability mandate, may have a lot of power in determining when is the Fed going to raise rates. And we'll learn a lot more about when the Fed's going to raise rates and what they're going to tell us about and how much notice they're going to give us in this video.
Near term, as the pandemic recedes and we see potentially a strong wave of spending as people return to their normal lives and begin consuming various services, there could be quite exuberant spending and we could see some upward pressure on prices. And
that's interesting. Here's the price stability aspect. He's suggesting as the economy returns to normal, we could see an insane amount of demand for products and services. Remember, services are a big thing. A lot of people during the pandemic, they don't have a house cleaner come anymore, if you can afford a house cleaner. A lot of people don't have as much babysitting anymore, right? Like there's so many things, so many types of services that have just kind of been put on hold. Oh, I don't want to move yet, so I don't need moving service. I don't need a real estate agent. That means I don't need escrow. That means I don't need title. All of these things, the service sector is so huge. We frequently, when we think about inflation, we think about products, but we got to forget about all the people who make our society work. And he's saying there could be some exuberant spending in the next year or two here as the economy goes back to normal.
At about the same time, we'll be seeing measured inflation go up because of base effects as we lap the low readings of the first of March and April of last year. So, in fact, that's quite possible. Indeed, that is in the forecast of many economists. But the real question is, how large is that effect going to be, and will it be persistent? So because clearly a one-time increase in prices that isn't very large is very unlikely to mean persistently high inflation. And that just is a function of the underlying inflation dynamics of the U.S. economy as they have been in the last many years. As you know, we have a flat Phillips curve, meaning there's still a small connection, but you need a microscope to find it between slack in the labor market and inflation. We've also got low persistence of inflation, so that if inflation were to go up for any reason, it doesn't follow. Inflation doesn't stay up, and that it used to be. If you go back to when I was an undergrad at Princeton, you had a steep Phillips curve, and it was combined with highly persistent inflation, and that's what gave you the inflation that I graduated into in 1975 and later in that decade. So dynamics will change, but they don't change. We don't think they change, quickly or on a dime, and we'll come back to that. I also think, let's say that does happen. Let's say we have a strong economy in the second half of the year, and that continues. Remember, we're a long way from maximum employment. There's plenty of slack in the labor market. Unlikely that wage pressures are going to be reaching a level that would support higher inflation. Also, second, the other factor I'd point to is look around the world. Shortage of demand in lots of large advanced economy countries around the world who began this crisis at deeply negative interest rates and have had little policy space with interest rates. Now, there are other things they can do and they are doing, but that all is going to hang around for a while. And
I'm going to pause there for just a second because there's a lot to unpack here. So this almost sounds a little counterintuitive because earlier he was saying that, hey, we're not going to raise rates when, unemployment goes down. That is, we get closer to maximum employment. Now he's basically saying the same thing from a different angle, though. He says, look, it's actually, even if there were a concern that low unemployment, aka lots of people having jobs, would push prices up, even if that were true, Jerome Powell thinks it's going to be a while before we actually see that employment. In fact, we know based on the summary or the Fed's summary of economic projections, we know that they don't actually think the unemployment rate is going to go down to under 4% until 2023 right here. Sure, we're going to see that large decline here from that 6 to 7 range into that 5 to maybe even 4 range by the end of 2021, but he still thinks there's going to be a good amount of slack until 2023 and beyond. He's being consistent here, but even if unemployment were low, he's basically told us, hey, the relationship between inflation and employment being really, really low is like microscopic. So AKA, if you're worried about inflation coming because people are going back to work, don't worry about that so much. Maybe there's more of a concern that we might see inflation in the short term because as people go back and the economy opens up again, people might be exuberant and spend like crazy again because they've been cooped up for so freaking long. Anyway, let's keep going.
The U.S. economy is strongly integrated with the rest of the world, and that's going to matter. I should add, of course, if inflation were to move up in ways that are unwelcome, we have the tools for that, and we'll use them. We will use them. No one should doubt that. That's, in a way, too low inflation is the much more difficult problem to solve. The big uptick in defaults that we thought we might see in non-financial corporates, we really haven't seen it. So it's just not something we are feeling or have ever felt, really. We will, when the time comes to raise interest rates, we'll certainly do that. And that time, by the way, is no time soon. We do not have a lot of time varying tools that are where we can see a particular situation. And
I can just quickly pause there and say it's a big statement. He says that time is no time soon to raise rates. There's a lot of talk that the Fed might change their mind and that they might raise the rates sooner because maybe inflation will come. And we'll hear more about Jerome's inflation expectations here, but he's being pretty consistent. He's saying, no, we're not anywhere close to raising rates. Let's keep going.
After that situation. And the history of those, we've had them over history, and it hasn't been a good history. It's very difficult to get the timing right and that sort of thing. What we do have is...
We're going to pause quickly and just say, what Jerome Powell here is saying is, as the Federal Reserve, with like 2,000 economists working for them, they have trouble timing the market. And this is a really good lesson. This is, in my opinion, a really great lesson if you're thinking about investing into stocks or investing into real estate or whatever. The Federal Reserve here is telling us, They suck at timing the market. They just respond to the market. It's a good lesson to keep in mind when we're thinking about investing, because I know there are a lot of folks that might sit on the sidelines and say, you know what, I'm gonna wait for the next crash, and I get it. It's prudent to have some cash around on the side, less margin, debt outstanding, but keep that in mind. Even the Fed here is saying they can't time the market. Let's keep listening.
Through the cycle tools. So the idea is we're not going to rely on our ability to put these things in effect at the right time and in the right proportion. We don't think we're very good at that. We think it's better to, as one of our mutual friends and colleagues likes to say, better to build strong levees than try to predict hurricanes.
Great quote. Better to build strong levees than to try to predict a hurricane. It's so funny because there's so many YouTube channels that exist right now that are like, that's it. This is the next SPAC that's going to the moon. And, if 3 out of 10 of them hit, hey, great, they're a hero, because then they'll only talk about the 3 that are winning. Personally, that's fine. This content exists. I think it's very dangerous. I think it's playing roulette. I think it's speculative. I actually do not think that Bitcoin is speculative. I think Bitcoin is volatile, but I do not think Bitcoin is speculative. But some of these SPAC companies that have no functioning sales and no functioning product, very, very scary to me. So I really resonate with this quote: build strong levees. Don't try to predict hurricanes. This is the stuff that I teach in my courses, and specifically when I talk about investing in companies that we know are going to be here and be strong for the next 10 years. Maybe you missed the boat on investing in Amazon over the last 10 years. That's fine. Amazon's still a good investment to make. It's a relatively safe investment to make, in my opinion. But golly, look at companies like Wayfair and Etsy that have a fraction of the market cap of Amazon, yet the attention that is growing on these platforms is out of this world. Pay attention. I prefer Etsy over Wayfair, but Wayfair is definitely in the running too. Both great companies. I've done a complete analysis on both of those. You could type that into YouTube, meet Kevin Etsy and Wayfair, and you'll find it. All right, let's keep going.
Arithmetic of the decline in the first and second quarters. The COVID shock was significantly larger, but really the 2 episodes are just fundamentally different, and the most important differences are not really about size. So if you go back to the global financial crisis and the Great Recession, they resulted from the buildup of unsustainable imbalances in the economy in the form of a housing bubble that popped. And then an undercapitalized banking system amplified that shock rather than absorbing it. And that system ultimately needed to be bailed out by the taxpayers.
What he's doing here is he's drawing a parallel between 2008, or responding to a request to draw a parallel between 2008 and the current crisis. How different are they really?
There were also lots of points of failure in the non-bank part of the financial system as well. And going into the crisis, household indebtedness was quite high, a lot of it in the form of completely unsupportable mortgages. So when the housing bubble popped, the housing sector was buried in debt and foreclosures came in, and you were in right away in a very, very slow and painful and long recovery. Very different situation here. The pandemic was effectively a natural disaster, right? And it struck an economy that was performing well. Now, every economy, and certainly our economy, faces plenty of longer run challenges. But I would say there were no obvious imbalances that threatened the long, ongoing expansion. You really can't identify something that looked like, if this blows up, it could blow up the expansion. The banking sector, as I mentioned, was much better.
Pay attention to that for a moment. This is so important. In 2019, I remember there were so many market crash videos about, that's it, the next market crash, it's around the corner. Nobody was pointing to the potential of, obviously, a pandemic. In fact, I remember talking on YouTube about, hey, just be prepared for a potential black swan, right? Black swan is something that comes out of nowhere, which we got, the pandemic. But in terms of conventional red flags that were showing in the economy in 2019, there weren't that many. And if any at all. Jerome Powell feels the same is true right now. He doesn't see many red flags now, just like he didn't see many red flags then. The issue becomes, okay, well, what happens if something totally unexpected happens? Again, like a natural disaster or pandemic. You still had a strong banking system. You still had a functioning economy. Let's listen into how he continues here. It's very interesting.
Capitalized, had much more liquidity, a far greater appreciation of its risks through thanks to stress testing and such. We did see some problems this time in the the non-bank sector of the non-bank sector, of the financial sector, but less so than in the GFC. Households were in relatively good shape going into after many years of deleveraging. Corporate leverage was high, as I mentioned, but we haven't seen really the payoff there in a negative way. So there's another, and you pointed to this, another critical difference is this time, both fiscal and monetary authorities responded very quickly and very powerfully and in a sustained way. Critically, it was sustained. And I would just say this was a particular shock that called for fiscal policy. What we can do is we can restore market function and sustain market function, and then we can stimulate aggregate demand with highly accommodative monetary policy. This situation with 25, 30 million people out of work overnight, effectively, called for fiscal policy more than, and we got it, in the form of the CARES Act, very, very large and very, very.
AKA, he's drawing this difference here that the 2008 crisis, people were so highly leveraged in real estate. Whereas in this situation, in 2019, people were actually paying down their debt. People were becoming less leveraged relative to values. Corporate debt was a little bit elevated, it was higher, but it wasn't as dangerous. The types of debts that were outstanding weren't as risky as the type of debt that was outstanding leading into the 2008 recession and, of course, market crash. And so this is where Jerome Powell is really saying, hey, when this pandemic hit, things happened so fast. It really takes Congress responding to that, and they did with the CARES Act. Now, we'll go into cryptocurrency and stablecoins and inflation a little bit in just one moment here.
Quickly, there's no close precedent at all since the Depression for what happened. And both reactions were swift and overpowering. So that was a big difference. And I think we did learn that. We learned come in early and come in hard and don't leave till the job is done. The last thing I'll say, other differences, just completely different, is the primacy of healthcare policy. The single most important economic policy in this is healthcare policy.
And this is Jerome really taking a step back out of what's happening in the economy by saying, hey, look, the biggest thing that changes this economy right now is people getting vaccinated, not monetary or fiscal policy. It's getting the pandemic dealt with.
It's two things. It's getting control of the spread of the virus, which we have not been able to do with much success yet. But it's also developing, medical innovations for treatment and ultimately vaccination.
Now we're going to talk about the U.S. debt. There is so much fear that the amount of debt the United States takes on to deficit spend, which we're going to get a lot more of when Biden unveils his stimulus proposal, it's going to be big. It's going to be probably $1.5 plus trillion. Let's see what Jerome Powell's take is on debt.
Relatively soon. And the key to that, the key thing there is maybe we'll be able to avoid a lot of the damage to people's lives, what we call labor market scarring. But what it really amounts to is people losing the life they've made in the workforce. And that's really the thing that we're most focused on is getting back to a strong labor market quickly enough that people's lives can get back to where they want to be. Because we were in a good place in February of 2020, and we think we can get back there, I would say, much sooner than we had feared. I just would say, first of all, the U.S. is not on a sustainable path at the federal government level in the simple sense that the debt is growing substantially faster than the economy, and that means, by definition, it's unsustainable. That's not to say that the level of debt is unsustainable, and it's not unsustainable. It's far from unsustainable. And so I think we're a long, long way from fiscal dominance in the United States if we ever get to that place. And it certainly is not a factor that we consider in any way at this time. So,
pausing there. Okay, so you need to know that fiscal dominance means that basically your GDP is growing faster than the debt is. And right now, Jerome Powell is saying we're not on a sustainable path with the amount of debt that we have. That means our economy is not growing faster than our debt is growing. Our debt is ballooning, and the economy cannot keep pace with this. That is very bad. But he says the level of debt is not a problem. That's because interest rates are low. He said that in prior remarks. And so what we really need to do now is transition to not necessarily being worried about the debt, but quickly transitioning to getting the economy firing on all cylinders again, so that way the economy is growing faster than the level of debt is growing. Bottom line, debt doesn't matter much right now. Focus on getting the economy moving, but we can't keep this debt going if the economy is going to stay stagnant.
High public debt in no way impacts monetary policy. Now, we are squarely focused on serving the public through our new framework to achieve maximum employment and stable prices. Let me start by agreeing that now is not the time to be talking about exit. I think that another lesson of the global financial crisis is be careful not to exit too early. And by the way, try not to talk about exit all the time if you're not, if you're sending that signal, because the markets are listening. The economy is far from our goals. And as I mentioned a couple times, we're strongly committed to our framework and to using our monetary policy tools until the job is well and truly done. And I think the taper tantrum, as you asked about the taper tantrum, it highlights, I think, the real sensitivity that markets can have about the path of asset purchases.
Basically here, what he's saying is, hey, taper tantrum is what happened in 2013 and 18 when the market started crashing short term because the Fed's like, all right, we're going to stop buying as many bonds. Jerome Powell's like, oh, no, don't worry. We're not going to stop. We're not change anything for the time being because he doesn't want to upset the market. He's like, markets are very reactive to that. Let's keep on.
We know we need to be very careful in communicating about asset purchases, and I'll come back to that in a second. A couple of general caveats is we always try to avoid an excessive focus on a particular likely path, the most likely or modal path for the economy, because monetary policy is only sometimes about the most likely path. It's often about how do you conduct risk management to avoid, downside cases. So that's a little bit why our guidance on both rates and asset purchases is not time-based. It's outcome-based. It requires the achievement of various objectives, and those objectives will come when they come, rather than when one might mark a calendar. You really can't do that in advance. But we will, of course, be very, very transparent as this comes, as we get close. So I would just say this on the current situation: when it does become appropriate for the committee to discuss, specific dates, and that will be when we have clear evidence that we're making progress toward our goals and that we're on track to make substantial further progress toward our goals. When that happens, and we can see that clearly, we'll let the world know. We will communicate very clearly to the public, and we'll do so, by the way, well in advance of active consideration of beginning a gradual taper of asset purchases. So that's how we're.
That's good. So here he's saying, hey, look, we will let you know well in advance of any changes if we're going to change. There's been a lot of speculation and rumor going around that that's it. Jerome Powell, he's going to realize inflation is coming. He's going to flip. He's going to change his opinion sooner, especially since we're expecting 3.5% inflation year over year in March and April because we had such a trough that we bailed out of from last year. That's going to freak out markets. And so Jerome Powell's saying, don't worry, we're not going to change anything. We're going to give lots of notice. We're going to do this very slowly. Last time Jerome Powell did this, he was fast. He did this in 2018. He pissed off the market so hardcore. The market sold off 16% in 60 days. The real estate market fell 12%. It was ugly.
About that. Let's say something about CBDC. So we don't have
okay, these are cryptocurrency stable coins.
An explicit plan to do what you articulated, but since we are the world's reserve currency, we actually think we need to get this right, and we don't feel an urge or need to be first. We have effectively, it means we already have a first mover advantage because we're the reserve currency. So, and I think there are both benefits and potential costs and unresolved questions around CBDC. And so we're committed to.
Just so you know the acronym, because it might be bothering you, it's Central Bank Digital Currency. And it would be probably maybe a stable coin or something like that. They are testing this. By the way, the more I research about crypto, the more I'm interested in it. And the more I think that, and I've said this, I think in this video already before, I do not think that Bitcoin is speculative. Volatile, but not speculative. Keep going.
Technology has made this possible. And, it's effectively private sector actors can create the equivalent of digital money. We know that in the past, when private sector money, the public sometimes just thinks of it as money, and then at some point they find out that it's not money, and that's a really bad thing we need to avoid. So we're going to look at it very, very carefully, and we're investing heavily in understanding the technology and analyzing the policy questions, the many policy questions that come. We will also do, as we go through this process, we'll do a great deal of outreach to every constituency that would be interested, including, elected representatives, including financial sector participants, including, as we did with the monetary policy review, the people we serve, to try to understand what are the use cases, do we need this, how would it help, what are the benefits, and I think all of that will inform our thinking as we go through it. So I think we're determined to do this right rather than quickly, and it will take some time. I think it'll take measured in years rather than months. But I would say, since it's possible and private sector is already kind of doing it, I think this is something we need to take very, very seriously.
That's big. That's big. Jerome Powell here saying that research into stable coins and cryptocurrency technology is a very, very high priority. And while the United States might not be the first to have a central bank digital currency, they will definitely have a first mover advantage since they are the world's currency reserve. Now, whether that means a central bank stable coin will take over the US dollar at some point in the future, maybe. That's entirely possible. Will Bitcoin take over as the world's currency? Probably not. I do not see that ever happening, because you can't create more Bitcoin. And come on, do you think the printers want to run dry at governments? It ain't gonna happen. It takes too much control away from governments. Bitcoin will be a very fascinating investment. In long run, I think a very profitable investment to make. But for the time being, the more talk we get from central banks considering stable term coins or currencies, the more we actually legitimize cryptocurrencies. The more cryptocurrencies get legitimized, well, the more Bitcoin goes to the moon. It's that simple. And it's absolutely incredible, because there's still so many people that are absolutely clueless about cryptocurrencies. Now, I consider myself next to clueless. I feel like I've been on the sort of, what's it called? A Mario Party circle, where I'm in the red circle on Mario Party, the bad one. And that is the clueless about cryptocurrency circle. And I have now moved one step off of that. But I still have a puzzle piece, or a puzzle ahead of me. Anyway, very fascinating comments here from Jerome Powell. It gives us some reiterations on his opinions on unemployment's impact on inflation itself, the impact of, stimulus, and also stable coins and cryptocurrency, and some of his thoughts around that. Very fascinating talk this morning. Really appreciated this. If you found this helpful, consider sharing it. And folks, we'll see you in the next video.